Hi everyone, welcome to the February video update from Endeavour. During the month, we saw new highs in equity markets and solid reporting season, which show the economy is performing relatively well. This helped alleviate some concerns around rich equity market valuations, which was pleasing to see. We also had on this call Dan Gafforini. He started with us in February, joined us from Thorney. In February, the market was up 1.2%. The growth balanced high conviction portfolios were up between 4.5 and 4.7%. We had two of our holdings receive takeover offers. So, Dan, how'd you do it?
Oh, I could say it's beginner's luck, but there'd be discounting the team's effort, so I won't say that.
Good answer. But yeah, seriously, we're excited to have Dan join the team. He's working side by side with Joe Carlton and myself. And when we were hiring an analyst, we ran through a process, a fairly thorough one. We had 120 applicants, and Dan's analytical skills were at standout. He's passionate, detailed, smart. He's a good fit for the team. So maybe Dan, over to you. If you could just tell us a little bit about yourself and your past work history for clients on this call.
Yeah, sure. So I started as an intern in industry 10 years ago, almost to the month. And through that period, most recently at Thorney for 4 years, focused on predominantly small caps, and working alongside one of the portfolio managers there and amongst the team. So yeah, got that sort of experience, I guess, in terms of small mid caps and push up into the large caps going forward, I would say. And yeah, focusing generally on that industrial space, technology, probably a lot of that sort of non-resources, non-pharma space, given the guys already have quite an extensive experience in that space. So I'll leave it to those guys and allows me to focus on the rest of the book.
Nice. And Dan was part of some changes that we spoke about with clients and in some video updates as well. Really starting in October last year, we made some changes to the management team, brought in some senior management to run the Endeavour business and allow the investment team to focus purely on the stocks. And added Dan to the investment team has just started 2 weeks ago, but pleasing to see since that turning point for the markets in our portfolio, 1st of November, All Ords accumulations up about 15.5%, and our portfolio is up between 17 and 19% after fees. So it's pleasing to return to a period of outperformance. We think this will continue, and this is probably best demonstrated by some of the changes we've been making in the portfolio. So we'll go straight into the stocks, and we'll keep it short. We know everyone's busy. First of all, in February, as we mentioned, Altium was one of the key contributors to performance. Altium received a takeover bid at $68 a share, values the company at $9 billion. And we initially invested in Altium at $6.30 in 2013. So this acquisition marks a significant milestone, yet a bit bittersweet for us because we have to part ways with one of the best companies on the ASX. But obviously can't complain too much. It was a 31% premium to the last trading price, and it really highlights management's world-class execution, in our opinion. Since we owned it, they compound revenues at 20% per annum, had strict cost control, they improved profit margins, and they had a 90% return on invested capital. So congratulations to the Altium team. It was a great outcome. And it was actually one of the key picks we spoke about in our January video update. So opportunity was there for everyone, and hopefully the next takeovers in this video. Talking about the update, another key pick was Life360 in that January video. That's one of our bigger holdings, and in March so far, it's up 45%, following a good reporting update on the Feb result. So we'll have more to say about that next month. There were two other stocks we spoke about that have performed quite well. WiseTech increased 30% in February, and Xero was up 15%. So Xero didn't report, but they had a investor day that Dan attended. So maybe Dan, do you want to talk about some of the learnings from that day?
Yeah, I might just take one step back as well. Just say that I guess Xero is one of the larger positions in the growth equities portfolio. It's in amongst all the other portfolios too, but different weightings and being held at different points in time. was up 15% in Feb, pretty much off the back of what was a well-received investor day. A lot of what they did was point towards their focus on their core strategy between FY25 to 27 being their sort of three main products, the core account, the payroll, and the payments. And then within their three core geographies, furthermore, being Australia, UK, and US. So I think that was received well by the market, and probably goes to show that that continued free cash flow growth and sustainability of free cash flow will keep coming through, because it's basically not going to get leaked out to other random projects and other random geographies and products and whatnot. It's just back to the core. I think what was further well received was the bolstering of the senior leadership team, as well as the guidance around OPEX and that coming down as a percentage of revenue from 75%. We'll be guiding to around 75%, down from 79% about 6 months ago. And then that should bode well for sort of the exit run rate into FY25 as well. So perhaps that's why the market is quite surprised to the upside in Feb.
And I'll just add, we've been taking some profits recently in all of those stocks we mentioned. Actually, they've had a big share price run recently, still maintain the holdings except for Altium, which we've exited, but just taking slight profits in WiseTech Zero after the share price performance, and slightly stretched valuations here. Another company worth talking about is Zip. We first bought Zip at 42 cents in December, rose 30% in February, and it just hit $1.20 today, which is triple our initial entry in December. Clients and potential investors on this call may know the company, and initially we were very skeptical. We thought it was an overvalued business dependent on low interest rates. It was a bit of a retail mania stock into the bubble in 2021. But we met management in December, and they have undergone a significant transformation. So they've exited non-core markets, launched new products, cut operational expenses. They've improved unit economics, and this has led to cash profitability, which the market wasn't forecasting. That's the sell side consensus. And it's also led to strong earnings growth, which they then demonstrated in the February result, which showed all of the above: better unit economics, cash leverage. USA is a standout. That's growing at 40% year on year. There is a few positive factors playing out with ZipTel at the moment, and we actually caught up with management again yesterday. So I think, and the rest of the team thinks, sort of joining the dots, that they can beat consensus estimates next year. And if we put them on a, say, 100 mil cash earnings, which is possible, and it's significantly above consensus, and it trades on a 25 times PE, this is a company that can double from today's share price. And it's worth noting, Altium was just taken over at 50 times. Now, Altium's a significantly higher quality business. We don't expect 50 times for Zip, but our point is, and my point is, that after the share price has gone from 40 cents to $1.20, there's still some valuation support here, and earnings momentum may continue to carry the stock higher. Having said that, due to the share price rally, it became our biggest position. We've taken profits. It's down around 3% now from 6%. Another company we added in January, just quickly, was WA1. It's a generational niobium discovery in Western Australia. Niobium is a critical mineral essential to the low carbon economy. Don't really have time to go through the drivers of our valuation right now, but it's up 25% since we invested in January. That was at $10. One that is yet to play out, might be worth talking about, that's EML. It's down slightly, but we think it's an opportunity. And Dan, you've done some good valuation work here on the sum of the parts valuation. Maybe that's worth touching on.
Yeah, so the business currently trades just shy of $1 per share. To cut through to the end, we basically think that it could be worth between $1.30 and $1.40 per share on a sort of say balanced upside view, versus around 70 cents per share on a downside view. So you've got that positive risk reward there. Just in terms of a little bit of background on the business, it was once around just shy of $6 a share. It's a global gifting business based in Australia and the UK. It's had a lot of change recently. Basically, a lot of the problematic part of the business is being liquidated and cut off, and what is left should be quite a profitable and attractive core business. And I don't think that's been appreciated by the market just yet. They're guiding to around 55 mil EBITDA in FY24, which puts on around 7 times, and this should probably come down with not too much growth being factored in. And with this cleanup process, I think it should open up the potential for it to become an M&A candidate in time as well.
So we think there's valuation support here. There's some catalysts this year. It's in the sin bin a bit from investors due to poor execution. Hopefully management can now realize some value for shareholders, which will benefit us. So we'll see this year.
I think on that point.
Yep,
just
you
go. It with that management focus, and now goes back to focusing on the core rather than worrying about the sort of problematic stuff that they've potentially been worried about for the last 12 to 24 months. So that will probably be soon to be appreciated.
Yeah, that's right. It's a bit similar to Zip in that way. Sort of some lessons were learned from the share price pullback. Zip, when we looked at it, it was down 95%, and then confirmed with management yesterday, and they've spoken about this publicly, that they're not going to get distracted. They're not going to acquire. They're not going to raise capital. The hard work's been done. Now they can sit back and just watch the business grow. Now, I'm sure they're overplaying that. I'm sure there's still quite a lot of hard work to do, but they're not going to get distracted, and they've learned some lessons. So we'll see. Hopefully EML management can execute. We're yet to see it. Share price is still around where we bought it, but fingers crossed this year we'll be paying close attention to it. Two others we'll just touch on quickly that we've traded recently. We had a holding Symbio that was too cheap, quite frankly, and it was taken over by Aussie Broadband. Now, we could elect whether to take cash or script. We took 100% script in Aussie Broadband, and fortunately the shares rallied 21% in February. So they brought out a result. It showed strong subscription growth, good return on invested capital, about 40 mil operational cash flow in the first half. Now, post the Symbio acquisition, it'll have about 1.3 billion revenue and 160 million EBITDA, and probably the fastest growing telco on the ASX. We think they can grow at 20% per annum organically, and they have 200 million reserves, so they can acquire. That 200 mil could result in 30% extra in earnings. So they also revised their guidance to the upper end for FY24 due to this operational leverage that's coming through. And then shortly after the result, the management team clearly don't sit still. They did a hostile raid of Superloop shares. They acquired 20% of the company and then lobbed a takeover bid. So we really hope they pull this off, because Superloop's growing strongly as well. It's good value, and there's significant synergies from joining the businesses together. Just on the high level, they'd have about 1.8 bill rev, 260 mil of EBITDA. So we think the stock will grind high this year. Is good value opportunity there. And just lastly, a couple of things on the resources. It's not all good news running a portfolio. Detractors this month were Whitehaven, South32, BHP. They all had their own reasons in the results, which we won't go into now, but also the resources sector was weak. It was down about 5.4% for the month. So they detracted from performance. And we had one company in the resources sector that contributed. We sold Stanmore Coal from the high conviction portfolio around $3.90. It's off about 13% since we exited, and we bought Metals Acquisition Corp. So this was a pure play copper asset. It's trading about 10% higher since entry, and it was an IPO on Australia at a 10% discount to the USA listing. So this is by far the best pure play copper exposure on the ASX. There aren't too many good opportunities here, and they have an asset in New South Wales. They've got capital to acquire. We think they can generate about 250 mil gross profit this year. So watch this space. This company doesn't require a rising copper price, but that'd be nice for some leverage as well. So that's about it for this month. just thinking forward to March, we'll be doing some client meetings in mid-March in Melbourne. So please let us know if you'd like to chat. Joe Carlton, investment committee and team member, will be in Melbourne along with Dan Gafforini and myself. So look forward to meeting and look forward to providing the next update next month. Thanks, everyone.